real risks for the sector emerge from, let's say, 2 or 3 important places. It's very simple things, right? How have you lent? Credit is, I think most people do credit well, most people. Unless and until somebody takes unnecessary risk, you do credit well. Nobody lends thinking ki NPA hoga, right? So, most people do credit well. What people forget is risk, right? That are we taking too much exposure to a sector? Are we taking too much exposure to a particular group? Are we taking too much exposure to a particular geography? What is important is to put very strict risk control, risk limits, risk appetite statement in place. So, this is number 1 on the asset side. On the liability side, if a NBFC is not seeing far enough or long enough, in a short-sightedness, sometimes what can happen is in the hunger to keep your borrowing costs low, you may just go too short. You may fund long-term balance sheet by long-term assets by short-term, and which will expose you to both interest rate risk and even more importantly liquidity risk. No NBFC or bank or any financing company can survive if the liquidity risk goes bad. And hence, even more than the asset side risk, managing of the liability side risk, making sure that even at a negative carry, even at an insurance premium, so to say, you don't overdo your hunger of having cheap funds and keep yourself liquid. It should get disproportionate attention. So, both these risks are real. These are simple financial risks. I have not yet come to the non-financial risk. These are financial risk, asset side risk, liability side risk. I normally talk very basic things. And the liability side risk doesn't get, according to me, enough attention across the sector. There are some companies, I think we give absolutely disproportionate attention to liability side risk. And just to give you an example, and I talked about it, we are very liquid. Our ALCO actually have representation from L&T Treasury, and this kind of we get a overall view. Our chief economist, who is a very well-known lady, Dr. Nitsure, she sits on ALCO. We take her opinions very seriously. We have a 3-tiered structure to manage interest rate risk. I just put up a presentation in the public space talking about it. The kind of the point I am trying to make is it's a risk which is just now coming into focus because of problems. But do you remember liability side risk being even talked about till 6 months back, right? Till 6 months back when interest rates go. And this is the problem, because we focus as a NBFC sector or even banks, we focus too much on asset quality, credit, which is very important.
But
the liability side doesn't even get any attention, any space on television, analysts, nowhere.
No, fair point.
And that's very, very important.
In fact, I would like to take your opinion on this point, only taking it further. You just put up a analyst presentation on the website as well as on Bombay Stock Exchange website, which is actually getting a lot of attention due to one particular plate where you actually mentioned how half of your loan book is actually at a fixed rate and the large portion is floating, and you benefit from interest rates going up because rates are heading higher, yields are heading higher, and that has become a big issue for the entire sector.
Yes, and it's not a coincidence. We are in a happy position today. It's not a coincidence, but it comes from a very deep-rooted philosophy of mine. And many times, sometimes I sound like God's own truth, because I believe in certain philosophies. And this philosophy is that you have to provide for the rainy day when the going is good. When the going is bad, you should use those stories, right? The insurance premium that you have paid for all those time will come to your benefit, right? Most of the times, companies start doing certain things for risk when the going is bad. That's not the time. When the going is good, you are making a lot of money, and at that point of time, you should take some insurance premiums. On the asset side, you provide more when the going is good. Otherwise, you end up providing where NPAs are going up. Actually, you should provide when the going is good. We started doing that after we adopted Ind AS, and we increased our provision coverages when NPAs are coming down, right? On the liability side, when the interest rates were coming down, the temptation to go short, to further reduce interest rates, because on the asset side your yields are coming down, right? The temptation of drastically reducing interest rates by going short is very high, but we kept away from that. In the same principle that you use for provisioning on the asset side, we went long. When the interest rates were coming down, our economists saw that okay, the cycle is about to turn, and close to 53% of our liabilities we booked for 4 years now residual maturity, and at about 8.2, 8.3%, which was very high at that time. Because that time, you know, short term money was available at maybe 7 or even lower. And that time we booked at 8%. And okay, I told my asset side that yes, I am increasing my liability cost to buy an insurance premium, and you have to make that money. And today, yes, we in the proverbial way, we are laughing all the way to the bank. But you know, it's not luck, it's the cost, it's the insurance premium that we have taken when interest rates were coming down. Yeah. And there is one chart which shows that our interest cost has actually gone up by 3 basis points in the last 3 or 4 months, when market costs have gone up by almost 100 basis points, right? And that has happened because of this. So as you rightly said, just 47% of my liabilities will come up for repricing, and vis-a-vis 65% of my assets which will come up for repricing.
So much higher contribution.